I've been investing for more than 70 years now. I bought my first stock when I was 11 years old. That was 1942, right in the middle of World War II. And over those 7 decades, I've seen every kind of market environment you can imagine. Bull markets that seemed like they'd never end. Bear markets that felt like the world was ending. Periods of low inflation and high inflation. Interest rates at 15% and interest rates at 0. Through all of it, one question keeps coming up. Should I own stocks or bonds? It's a fundamental question that every investor has to answer, and the answer isn't the same in every environment. There have been periods in my career where bonds were clearly the better choice. The early 1980s, for example, when you could buy long-term treasury bonds yielding 15%. That was essentially a risk-free way to double your money every 5 years. I loaded up on bonds during that period, and it was one of the best decisions I ever made. But there have been other periods where stocks were obviously superior, most of the time, actually. And right now, in late 2025, as we head into 2026, I have very strong views on the stocks versus bonds question. Views that are shaped by decades of experience, by understanding how these asset classes work, and by looking at the current valuations and economic environment with clear eyes. Before I tell you my conclusion, let me explain how I think about this decision. Because if you don't understand the framework, the answer won't make sense. And more importantly, you won't know when the answer should change based on shifting market conditions. Let's start with what bonds actually are. A bond is a loan. When you buy a bond, you're lending money to a corporation or government. They promise to pay you interest at regular intervals and return your principal at maturity. That's it. There's no growth, no compounding beyond the stated interest rate, no participation in economic expansion or business success. You get exactly what was promised, assuming the borrower doesn't default. Now, this certainty has value. If I buy a 10-year treasury bond yielding 4.5%, I know with absolute confidence that I'll receive 4.5% annual interest for 10 years and get my principal back at maturity. The U.S. government has never defaulted on its debt, and almost certainly never will, because it can print money to pay its obligations. That certainty is worth something, particularly for people who need predictable income or who can't tolerate volatility. But here's the critical thing to understand about bonds. They're a bet against inflation. The dollars you get back in 10 years will be worth less than the dollars you invest today because of inflation. If inflation runs 3% annually over that decade, your 4.5% nominal return becomes a 1.5% real return after adjusting for purchasing power loss. That's not much wealth creation. And if inflation surprises to the upside, which it often does, your real returns could be 0 or even negative. Imagine buying a 10-year bond yielding 4.5% and then watching inflation accelerate to 5 or 6%. You're locked into that 4.5% rate while your purchasing power erodes faster than your interest income grows. You're losing money in real terms, and there's nothing you can do about it until the bond matures. This is exactly what happened to bond investors in the 1970s. People bought bonds in the late 60s and early 70s, expecting modest inflation like they'd experienced in the 50s and early 60s. Instead, they got the great inflation with consumer prices rising 8, 9, 10% annually. Those bondholders got destroyed in real terms. Their nominal returns were positive, but their purchasing power collapsed. Now let's talk about stocks. A stock represents ownership in a business. When you buy a share of Coca-Cola or Apple or Berkshire Hathaway, you own a piece of that company. You participate in its earnings, its growth, its dividends, its success or failure. The value of your ownership stake fluctuates based on how the business performs and how other investors value that performance. Stocks are fundamentally different from bonds in one crucial way. They're claims on real productive assets and cash flows that can grow over time. Coca-Cola's earnings can grow. Apple can innovate and sell more products. Berkshire can acquire more businesses and compound its book value. There's no cap on the upside the way there is with bonds, where you're locked into a fixed payment stream. This growth potential means stocks are a natural inflation hedge in a way bonds can never be. When inflation rises, good businesses can usually raise prices to maintain their profit margins. Coca-Cola charges more for a bottle of Coke. Apple raises iPhone prices. My utilities collect higher rates to offset higher costs. The nominal earnings of these businesses rise with inflation, and therefore their stock prices rise too over time. I'm not saying stocks are a perfect inflation hedge in the short run. They're not. In the 1970s, stocks struggled badly despite being ownership stakes in productive businesses. But over longer periods, decades, stocks have consistently outpaced inflation because businesses can adapt and grow their earnings. Bonds can't adapt. They're fixed contracts that inflation slowly eats away. Let me give you some historical perspective that shapes my thinking. From 1926 through 2024, stocks have returned about 10% annually, including dividends. Bonds have returned about 5 to 6%. That 5 percentage point annual difference compounds into an enormous wealth gap over time. $1 invested in stocks in 1926 would be worth something like $11,000 today. That same dollar in bonds would be worth maybe $200. Now, the stock investor had to endure a lot of volatility to get those returns. The Great Depression, World War II, multiple recessions, the 1973 to 74 crash, 1987, 2000 to 2002, 2008, 2020. There were many periods when stock values fell 30, 40, even 50%. That's psychologically difficult. Many investors panic and sell at the worst possible times. But here's the thing. If you could hold through those downturns, if you had the temperament and the time horizon to wait for recovery, stocks dramatically outperform bonds. The volatility was the price you paid for superior long-term returns. And for most investors, particularly younger people building wealth for retirement decades in the future, that's a price worth paying. So with all that background, let me tell you what I'd choose if I had to make a decision right now between stocks and bonds. And I want to be absolutely clear. I'd choose stocks, and it's not even close. Let me explain why. First, let's look at current bond yields. As of late 2025, 10-year Treasury bonds yield around 4.5%. 30-year Treasuries yield maybe 4.7%. Corporate bonds yield a bit more depending on credit quality, maybe 5 to 6% for investment-grade debt. These are decent yields by the standards of the past 15 years when rates were near zero, but they're not attractive in absolute terms or relative to stocks. Think about what that 4.5% Treasury yield represents. It's a guaranteed nominal return before inflation. But inflation is running around 3% currently, and there's no guarantee it won't accelerate, so your real return is maybe 1.5% if inflation stays tame. If inflation averages 3.5 or 4% over the next decade, which is entirely possible given massive government deficits and the political difficulty of controlling spending, your real return could be 1% or less. 1% real returns don't build wealth. They barely keep pace with population growth. Over 10 years, your purchasing power increases by about 10%. Over 30 years, maybe 35%, that's not going to fund a comfortable retirement or create generational wealth. You're essentially treading water in real terms. Now let's look at stocks. The S&P 500 currently trades at around 19 to 20 times earnings. That's what we call the price to earnings ratio. It means you're paying $19 or $20 for every dollar of annual corporate earnings. Flip that ratio around and you get what's called the earnings yield, 1 divided by the P/E ratio. At a P/E of 20, the earnings yield is 5%. That 5% earnings yield is the return you'd get if companies paid out all their earnings as dividends and didn't grow at all. But of course, companies don't pay out all their earnings. They retain some to reinvest in growth, buy back shares, pay down debt, make acquisitions. And over time, corporate earnings grow roughly in line with nominal GDP growth, which has historically been around 6% annually in the United States. So if I buy the S&P 500 today at 20 times earnings, I'm getting a 5% earnings yield plus whatever earnings growth occurs over my holding period. If earnings grow 5% annually, which is modest by historical standards, my total return would be about 10% annually. That's more than double the 4.5% I'd get from Treasury bonds. But wait, it gets better for stocks. That 10% return is mostly in the form of capital gains, not interest income. Capital gains are taxed at lower rates than interest. Income, they're only taxed when realized, so I can defer taxes indefinitely by not selling. And if I hold stocks until death, my heirs get a step up in basis that eliminates embedded capital gains entirely. Bonds don't have these tax advantages. The interest is taxed every year at ordinary income rates. After accounting for taxes, the gap between stocks and bonds widens even further. A 4.5% bond might net me 3% after taxes if I'm in a high bracket. A 10% stock return might net me 8 or 9% after taxes because of preferential capital gains treatment and the ability to defer realization. That's a 6 percentage point annual difference, which compounds into a massive wealth gap over decades. Now, I can hear the objection already. Warren, you're comparing nominal returns without adjusting for risk. Stocks are much more volatile than bonds. They can fall 50% in a year. Bonds are stable and safe. Shouldn't we account for that difference? And my answer is, it depends on your time horizon and your temperament. If you need money next year or in 2 years, stocks are too risky. The market could crash right when you need to sell. In that case, bonds or cash make sense because you need certainty about your principal. But if your time horizon is 10, 20, or 30 years, the short-term volatility of stocks is irrelevant. What matters is the long-term compounding of earnings and the fact that stocks have never had negative returns over any 20-year period in American history. Let me put it another way. The risk with bonds isn't volatility. Bond prices don't fluctuate much day to day. The risk is permanently earning inadequate returns that don't keep pace with inflation. You might sleep well at night holding bonds, but you'll wake up in 30 years and realize you're not much wealthier in real terms than when you started. That's a different kind of risk, and I think it's actually worse than the temporary volatility of stocks. There's another factor that makes stocks attractive relative to bonds right now: the quality of underlying assets. When I buy stocks, I'm buying ownership stakes in the world's best businesses. Companies like Apple, Microsoft, Google, Berkshire Hathaway, Johnson & Johnson, Procter & Gamble. These companies have wide competitive moats, generate enormous cash flows, operate globally, and have proven they can thrive through multiple economic cycles. When I buy bonds, I'm lending money to the U.S. government, which is running trillion-dollar deficits with no plan to balance its budget. Or I'm lending to corporations that might face competitive challenges or management mistakes. The quality of the asset I'm buying is just fundamentally different. But I'd rather own a piece of Apple's innovation and brand and ecosystem than lend money to the government at 4.5%. Let me talk about a specific scenario that illustrates my thinking. Suppose I have $100,000 to invest, and I need to choose between a 10-year Treasury bond at 4.5% or the S&P 500 index. With the bond, I know exactly what I'm getting: $4,500 per year in interest plus my $100,000 back at maturity. Over 10 years, that's $45,000 in interest income, and I end with $100,000 in principal. Total value, $145,000 before taxes, maybe $125,000 after taxes, depending on my bracket. With stocks, the outcome is uncertain. But based on historical returns and reasonable expectations, I might see the S&P 500 grow at 8 to 10% annually over the next decade. At 8% annual growth, my $100,000 becomes $216,000. At 10%, it becomes $259,000. Even after paying capital gains tax on the appreciation, I'm looking at $190,000 to $220,000 after tax. That's $60,000 to $95,000 more than I'd have with bonds. But yes, there's a chance stocks perform poorly over that decade. Maybe we hit a severe recession and the market goes nowhere for 10 years or even declines. But even in that scenario, I'm collecting dividends of maybe 2% annually, and I own stakes in productive businesses that will eventually recover and grow. With bonds, there's no upside if I'm wrong about inflation staying low. I'm locked into 4.5% no matter what. The asymmetry favors stocks dramatically. The upside case for stocks is much better than the upside case for bonds and the downside case for stocks. While more volatile, isn't necessarily worse than the downside case for bonds if inflation surprises to the upside. Now let me address some specific situations where someone might reasonably choose bonds over stocks. If you're retired and living off your portfolio, you might need the stability and predictability of bond income. Watching your stock portfolio fall 30% would be terrifying if you're depending on it for living expenses. In that case, having a significant bond allocation makes sense to provide stability and predictable income. If you're saving for a specific goal in the near term, like a house down payment in 3 years, stocks are too risky. You can't afford to see your savings decline right when you need the money. Bonds or CDs make more sense for short-term savings goals, where principal preservation is paramount. If you have such a weak stomach for volatility that you'd panic and sell stocks during a crash, you're probably better off in bonds. Better to earn lower returns and sleep well than earn higher theoretical returns, but make emotional decisions that destroy wealth. Know yourself and invest accordingly. But for most people, particularly younger people, accumulating wealth for retirement decades in the future, stocks are clearly superior to bonds in the current environment. The combination of reasonable valuations, earnings growth potential, inflation protection, and tax advantages makes stocks the obvious choice. Let me talk about what could change my view. If bond yields rose significantly, say to 7 or 8%, while stock valuations remained elevated, the calculus would shift. At 7 or 8% yields, bonds start offering attractive real returns, even after inflation. In the early 1980s, when Paul Volcker pushed interest rates to 15% to crush inflation, bonds were genuinely competitive with stocks. You could lock in double-digit yields risk-free. That was a unique opportunity. Similarly, if stock valuations got crazy expensive, say 35 or 40 times earnings like they did at the peak of the dot-com bubble, I'd be much more cautious. At those valuations, the earnings yield on stocks drops to 2 or 3%, barely better than bonds, and you're not being compensated for the additional risk and volatility. In that environment, I might prefer the safety of bonds until stock prices came back to earth. But we're not in either of those extreme environments right now. Bond yields are moderate. Stock valuations are reasonable by historical standards. The balance clearly tilts towards stocks for long-term investors. There's another dimension to this question that I think is important: the economic environment we're likely facing over the next decade. We have massive government debt that needs to be financed. We have demographic pressures with aging populations in developed countries. We have geopolitical tensions and potential reshoring of manufacturing. We have ongoing technological change driven by artificial intelligence and other innovations. All of these factors suggest to me that inflation will be structurally higher over the next decade than it was in the 2010s. Maybe not 1970s level inflation, but probably averaging closer to 3% than 2%. In that environment, fixed rate bonds yielding 4.5% offer minimal real returns. Stocks, with their ability to grow earnings and raise prices, are much better positioned. I'm also thinking about the quality of management and capital allocation. When I buy stocks, particularly through an index fund, I'm getting exposure to the best managed companies in the world. CEOs who are focused on shareholder returns, boards that demand accountability, competitive markets that punish poor performance. The capital allocation is generally rational because companies that misallocate capital lose market share and get replaced by better competitors. When I buy government bonds, I'm lending to entities that are not disciplined about capital allocation. Governments spend money for political reasons, not economic ones. They run deficits because it's politically easier than making tough choices. There's no market discipline, no competition, no mechanism to ensure my money is being used productively. That concerns me as a lender. Let me share a personal anecdote that shaped my views on this topic. In the late 1970s and early 1980s, I wrote extensively about the challenges facing stock investors in an inflationary environment. I pointed out that stocks had gone nowhere in real terms for more than a decade, despite the economy growing. It was a difficult period for equity investors, but even then, I remained convinced that owning good businesses was better than owning bonds. I focused Berkshire's portfolio on companies with pricing power, low capital intensity, and strong competitive positions. Businesses that could thrive even in a high inflation environment. Companies like See's Candies, where we could raise prices to offset higher costs, and the Buffalo News, which had a monopoly in its market. Those businesses performed beautifully through the inflation of the 70s and 80s. Their earnings grew, their intrinsic values increased, and patient shareholders who held through the volatility were well rewarded. Meanwhile, bond investors watched their purchasing power erode. The lesson stuck with me: own productive assets with pricing power, not fixed claims denominated in depreciating currency. That experience reinforced a key insight. You want to own businesses, not bonds, in almost all environments, except when bonds are yielding truly exceptional returns that compensate for inflation risk. We're not in one of those exceptional periods right now. Let me talk about diversification, because some people argue you should own both stocks and bonds regardless of relative valuations. The idea is that bonds provide ballast during stock market crashes, reducing portfolio volatility and helping investors stay the course. There's some merit to this argument, particularly for investors who can't handle the emotional roller coaster of an all-stock portfolio. But I've never been a big believer in diversification for its own sake. Charlie Munger used to say that diversification is protection against ignorance. If you know what you're doing, you can make concentrated bets on high-quality opportunities. Diversifying into mediocre investments just to reduce volatility doesn't create wealth, it prevents it. My approach has always been to own a concentrated portfolio of wonderful businesses and hold enough cash to never be forced to sell at inopportune times. The cash serves the same function that bonds would serve in a traditional portfolio, providing stability and optionality, but without locking me into low fixed returns. If stocks crash, I have cash to deploy at bargain prices. If opportunities arise, I can act quickly. Cash gives me flexibility that bonds don't. That said, I recognize not everyone can or should follow my approach. Most people don't have the temperament for concentrated portfolios or the discipline to hold cash without investing it. For them, a conventional portfolio with a mix of stocks and bonds makes sense. But even for those investors, I'd argue the stock allocation should be much higher than the bond allocation in the current environment. Maybe 75% stocks, 25% bonds, or 80-20, not 50-50, which is what many financial advisors recommend. The traditional advice of subtracting your age from 100 to determine your stock allocation seems outdated to me. That formula would have a 40-year-old holding 60% stocks and 40% bonds. But a 40-year-old has 25 or 30 years until retirement. That's a long enough time horizon that they should be heavily weighted towards stocks. I'd suggest 90% stocks, 10% bonds for a 40-year-old in the current environment. As you get older and closer to retirement, increasing your bond allocation makes more sense. By age 65, maybe you're at 60% stocks, 40% bonds. By age 75, maybe 50-50. The key is matching your asset allocation to your time horizon and need for stability. But even in retirement, I'd argue for maintaining significant stock exposure, because retirements last 20 or 30 years now. You need growth to offset inflation over that time horizon. So let me address one more consideration: the role of international bonds and stocks. Should I be looking at foreign bonds yielding more than U.S. Treasuries? Should I diversify my stock holdings globally? My answer is that I'm much more comfortable with U.S. assets than foreign assets for several reasons. First, the U.S. has the deepest, most liquid capital markets in the world. I can buy and sell easily at fair prices. Many foreign markets lack that liquidity. Second, the U.S. legal system protects property rights and shareholder interests better than most countries. Third, U.S. companies operate globally anyway, so owning the S&P 500 gives me international exposure without the complexity and risks of directly owning foreign securities. As for foreign bonds, higher yields in other countries usually reflect higher inflation expectations or currency risk or political risk. I'm not excited about buying Brazilian or Turkish bonds just because they yield more than treasuries. The extra yield compensates for real risks I don't want to take. So my portfolio preference is simple. U.S. stocks for long-term growth, U.S. Treasury bills or money market funds for liquidity and safety. I don't need the complex diversification strategies that academics and consultants recommend. Keep it simple, own quality, think long-term. Let me wind this down with a clear statement of my conclusion. If I had to choose between stocks and bonds right now, I'd choose stocks without hesitation. The expected returns are superior, the inflation protection is better, the tax treatment is more favorable, and the quality of underlying assets is higher. The short-term volatility is the price I pay for superior long-term wealth creation, and I'm willing to pay that price. This doesn't mean stocks can't fall. They can and will. We'll have recessions, corrections, bear markets. There will be periods when bond investors are smug because their portfolios are stable while stock investors watch their values decline. But over complete cycles, over decades, stocks will dramatically outperform bonds for patient investors who can stay the course. The key is having the right temperament. If you're going to panic and sell when stocks fall 20 or 30%, you probably shouldn't own stocks. But if you can view declines as buying opportunities, if you can focus on the long-term earnings power of the businesses you own rather than short-term price fluctuations, if you can think like a business owner rather than a stock trader, then stocks are clearly the better choice. I've been through enough market cycles to know how this plays out. The investors who build lasting wealth are the ones who own good businesses through thick and thin. The ones who panic and rotate into bonds to feel safe usually end up with inadequate returns and regret their decisions years later. The volatility of stocks is temporary. The low returns of bonds are permanent. So, to answer the question directly, stocks over bonds, and it's not close. Own an index fund if you want diversification and simplicity. Own individual stocks if you have the time and inclination to research companies, but own stocks. Let the earnings and dividends compound for decades. Reinvest everything. Stay patient through the inevitable downturns, and 30 or 40 years from now, you'll be amazed at the wealth you've built. Let me elaborate on this by walking through some specific real-world examples that demonstrate why I feel so strongly about this. I think looking at actual numbers and actual companies helps crystallize the argument in a way that abstract theory doesn't. Consider Coca-Cola, which I've owned since 1988. When Berkshire bought our position, we paid roughly $1,299,000,000 for about 400 million shares. At the time, that seemed like a lot of money for a beverage company. Some people thought I was crazy paying that much, but I understood the business, the brand, the moat, the cash generation. I knew we were buying something special. Today, those shares are worth over $25 billion. But that's not even the best part. Over the past 36 years, Coca-Cola has paid us more than $8 billion in dividends. Think about that. We've collected $8 billion in cash while still owning an asset worth $25 billion. Our cost basis has essentially been returned to us multiple times over through dividends alone, and we still own this crown jewel of a business. Now, what if I'd put that $1.3 billion into 30-year Treasury bonds back in 1988 instead? The bonds would have yielded maybe 8 or 9% at the time. Over 36 years, I'd have collected roughly $4 billion in interest payments. But at maturity, I'd get back my $1.3 billion in principal, not $25 billion. The total return from bonds would have been about $5.3 billion. From stocks, it's been over $33 billion. That's more than 6 times better with Coca-Cola than with bonds. And here's the kicker. Those bond interest payments would have been taxed as ordinary income every single year. The stock gains have been mostly unrealized capital gains that I haven't paid tax on yet, and when I do, they'll be taxed at lower capital gains rates. The after-tax difference is even more dramatic. This isn't cherry-picking one winner. Let me give you another example. American Express. We've owned Amex since the 1960s. I bought it after the salad oil scandal when the stock was beaten down and nobody wanted to touch it. I understood that American Express had a valuable brand and that the scandal, while embarrassing, didn't destroy the fundamental business model. The company survived, thrived, and our investment has been worth many billions more than we paid. Through all these decades, American Express has paid us enormous dividends. The company has grown its earnings. The stock has appreciated. If I'd owned bonds instead, I'd have just collected interest and gotten my principal back. No growth, no compounding beyond that fixed rate, no participation in the success of a great business that kept getting better over time. These examples aren't flukes. They're the natural result of owning high-quality businesses for long periods. Good businesses grow their earnings over time. They increase dividends. They gain market share. They benefit from inflation because they can raise prices. They compound intrinsic value in ways that bonds simply cannot. Now, let me talk about something that doesn't get discussed enough, the psychological and behavioral aspects of the stocks versus bonds decision.
This matters more than most people realize because investment success isn't just about choosing the right assets. It's about having the discipline to stick with your strategy through difficult times.
Bonds feel safe. When you own a bond, you know exactly what you're getting. The interest payments arrive like clockwork. The principal comes back at maturity, assuming no default. There's no mystery, no volatility, no uncertainty. This psychological comfort is valuable for some people. If it keeps you invested instead of hoarding cash under your mattress, then bonds serve a purpose. But that feeling of safety can be deceptive. Bonds have a different kind of risk that's less visible but potentially more damaging. The risk of earning inadequate returns that don't support your goals. If you retire at 65 with $1 million in bonds yielding 4.5%, you're generating $45,000 in annual income after taxes, maybe $35,000. Can you live on that? And what happens when inflation erodes the purchasing power of that income over 20 or 30 years? Compare that to retiring with $1 million in dividend-paying stocks yielding 3%. That's $30,000 in annual income, less than the bonds initially. But those dividends will grow over time. Quality dividend payers like Johnson & Johnson, Procter & Gamble, and Coca-Cola have raised dividends for decades consecutively. After 10 years, your $30,000 in annual dividends might be $50,000. After 20 years, maybe $80,000. And your principal is probably appreciated too. So your nest egg is now worth $2 or $3 million instead of $1 million. And the bond investor started with higher income but ended up worse off because bonds don't grow. So the stock investor had lower initial income but much better long-term outcomes. This is the trade-off most people don't fully appreciate. They focus on the initial yield or the short-term volatility and miss the long-term compounding story. Let me address a common concern I hear. What about sequence of returns risk? This is the idea that if you retire right before a major stock market crash, your portfolio gets devastated and you never recover because you're withdrawing money for living expenses while values are depressed. This is a legitimate concern for retirees, and it's one reason why having some bonds in retirement makes sense. But here's the thing, sequence risk is primarily an issue if you have a high withdrawal rate and no flexibility in your spending. If you're withdrawing 6 or 7% of your portfolio annually and the market crashes 50%, you're in trouble. You're selling shares at depressed prices to fund your lifestyle, and you might run out of money. However, if you have a more conservative withdrawal rate of 3 to 4%, and if you have some flexibility to reduce spending during down markets, sequence risk becomes much more manageable. You can live off dividends during the crash without selling shares. You can cut discretionary spending temporarily. You can work part-time if needed. Having options and flexibility is more valuable than having a big bond allocation earning low returns. There's also the question of what happens to bonds during the kind of crisis that causes stocks to crash. People assume bonds always hold their value, but that's not true. If we have a sovereign debt crisis or a major inflation scare, bonds could fall sharply in value too. Long-term bonds are incredibly sensitive to interest rate changes. If rates spike 2 or 3 percentage points, the market value of existing bonds can fall 20 or 30%. So much for safety. The only truly safe bonds are short-term treasuries or cash equivalents that mature quickly and can be reinvested at new higher rates. But those pay very low yields, often less than inflation. So you're sacrificing returns for safety, and you're still exposed to inflation risk. There's no free lunch. Every asset has risks. The question is which risks you're better equipped to handle. For me, I'd much rather handle the volatility risk of stocks than the purchasing power risk of bonds. Volatility is temporary and psychological. It only matters if you're forced to sell at the wrong time. Purchasing power erosion is permanent and mathematical. Every year you hold bonds with yields below the inflation rate. You're getting poorer in real terms. Let me talk about dividends in more depth, because I think they're underappreciated in the stocks versus bonds debate. Dividends provide something that bonds do too, regular cash income. But unlike bond interest, dividends can grow over time, and dividend-paying stocks tend to be more stable, mature companies with proven business models and strong cash generation. If I build a portfolio of high-quality dividend stocks today, I could probably achieve a 3 to 4% yield. Companies like AT&T, Verizon, utilities, consumer staples, real estate investment trusts, these businesses generate reliable cash flows and return much of it to shareholders through dividends. The yield is lower than bonds initially, but it comes with growth potential and better tax treatment. Moreover, dividends provide a cushion during market downturns. When stock prices fall, dividend yields rise automatically if the company maintains its payment. This rising yield attracts income-focused investors and puts a floor under the stock price. Companies with long dividend histories are also psychologically committed to maintaining those payments, so they're less likely to cut dividends during recessions. I've seen this dynamic play out many times. During the 2008 financial crisis, most dividend aristocrats, companies that have raised dividends for 25 consecutive years or more, maintained their payments. Some even raised them. Yes, their stock prices fell because everything fell, but they kept paying dividends, and investors who held on collected income throughout the crisis and participated in the recovery. Compare that to bond investors in 2008. Many corporate bonds defaulted.
Even Treasury bonds, while they didn't default, saw their interest rates plummet to near zero over the following years as the Fed cut rates aggressively.
If you owned bonds maturing in 2008 through 2012, you had to reinvest at yields of 2 or 3% or even lower. Your income fell off a cliff. Dividend investors generally maintained or grew their income streams. This income stability is one reason I'm so attracted to dividend-paying stocks. They provide the income that retirees and conservative investors need, but with growth potential that bonds lack. It's the best of both worlds if you're patient and can handle some price volatility. Now let me talk about a scenario that would genuinely make me prefer bonds over stocks. It's not just about yields rising or valuations falling. It's about the relative attractiveness changing dramatically. In the early 1980s, you could buy 30-year Treasury bonds yielding 14 or 15%. That's an extraordinary risk-free return. Even after inflation running 6 or 7%, you're earning 7 or 8% real returns guaranteed for 3 decades. At those yields, bonds become genuinely competitive with stocks. Why take the volatility risk of equities when you can lock in high single-digit real returns risk-free? I loaded up on bonds during that period, and it was the right decision. The bonds generated phenomenal returns as interest rates fell over the next 2 decades, and the high yields provided excellent income. But that was a unique moment in financial history. Paul Volcker had jacked interest rates up to break the back of inflation. Bond yields had spiked to levels never seen before or since. It was an anomaly, an extreme situation that created an extreme opportunity. We're nowhere near that today. For bonds to be truly attractive relative to stocks today, I'd need to see yields around 7 to 9% at minimum. At 7%, bonds would be yielding more than stocks' earnings yield, and they'd provide real returns of 3 to 4%, assuming inflation stays around 3%. That would be a tough decision. I'd probably still lean towards stocks because of the growth potential and tax advantages, but it would be close. At 9 or 10% bond yields, I'd seriously consider loading up on bonds. That happened briefly in some corporate bonds during the 2008 crisis. High-quality companies like Johnson & Johnson and Procter & Gamble saw their bond yields spike to 8 or 9% during the panic. Those were incredible opportunities. Risk-free or nearly risk-free returns approaching stock market historical returns. I'd take that deal all day. But again, we're not in that environment. Current bond yields of 4 to 5% just don't excite me. They're barely above inflation. The real returns are minimal. I need to see yields at least 50% higher, probably double, before I'd choose bonds over stocks. Let me also address the role of corporate bonds versus government bonds in this discussion. Some people argue that corporate bonds offer higher yields than treasuries and therefore might be more competitive with stocks. Investment-grade corporate bonds might yield 5.5 to 6% right now, about 1 to 1.5 percentage points more than treasuries. That extra yield compensates you for credit risk, the chance that the company defaults or struggles financially. For high-quality companies like Microsoft or Johnson & Johnson, that risk is minimal. They're not going bankrupt. But the extra yield still isn't enough to make corporate bonds attractive relative to stocks, in my view. Here's why. If I'm taking credit risk by buying a corporate bond, why not just buy the stock instead? The stock has unlimited upside if the company thrives, while the bond has capped returns. The stock gets preferential tax treatment. The stock participates in earnings growth. The only advantage of the corporate bond is lower volatility and seniority in the capital structure if things go wrong. But if I'm confident enough in the company to lend it money through buying its bonds, I should be confident enough to own its equity. And if I'm not confident enough to own the equity, why am I taking credit risk in the bonds? There's a logical inconsistency there. Either the company is high quality and I should own the stock, or it's questionable and I shouldn't touch it at all. The exception would be distressed corporate bonds trading at deep discounts. If I can buy a bond for 60 cents on the dollar that's likely to pay off at par, that's a compelling risk reward. But that's really more like equity investing than traditional bond investing.
You're looking for mispriced securities with asymmetric payoffs, not stable income streams. For traditional corporate bonds trading near par, I just don't see the appeal at current yields.
I'd rather own the stocks or stick with ultra-safe treasury bonds if I need stability. The middle ground of investment-grade corporate bonds doesn't offer enough extra return to justify the credit risk and complexity. Let me talk about inflation in more detail because it's so central to the stocks versus bonds decision. I've lived through multiple inflationary periods. The gradual inflation of the 1950s and 60s, the high inflation of the 70s, the disinflation of the 80s and 90s, and the ultra-low inflation of the 2010s. Each period taught me something about how different assets perform. What I've learned is that stocks are imperfect but ultimately decent inflation hedges, while bonds are terrible inflation hedges unless you get lucky with timing. When inflation accelerates, bond yields rise to compensate, but existing bonds fall in value. If you hold to maturity, you get your principal back, but in depreciated dollars that buy less than when you invested. Stocks suffer in the short run when inflation accelerates because higher discount rates compress valuations. But good businesses adapt. They raise prices, they restructure operations. They find ways to maintain profit margins. After an adjustment period, stock prices typically catch up to reflect the new higher nominal earnings driven by inflation. I saw this in the 70s. Stocks struggled from about 1968 to 1982. The market went essentially nowhere in nominal terms and fell significantly in real terms. It was brutal for equity investors who expected the kind of returns they'd enjoyed in earlier decades. But businesses kept operating. Earnings grew nominally, even if they shrank in real terms. And when inflation finally broke in the early 80s, stocks took off on a multi-decade bull run. Bond investors during that period got destroyed. If you bought 30-year bonds in 1968, yielding 5 or 6%, you watched inflation average 7% over the next 14 years. Your real returns were negative. You lost purchasing power every single year. And when you finally got your principal back in 1998, those dollars were worth a fraction of what they were worth when you invested. Meanwhile, if you bought stocks of good businesses in 1968 and held them through the inflation and malaise, you did fine. Not great in the short run, but fine over the full period. And if you had the courage to buy more stocks in 1974 or 1982 when everyone was pessimistic, you made a fortune over the subsequent decades. This historical lesson reinforces my preference for stocks over bonds. I don't know what inflation will do over the next 10 or 20 years. Nobody does. But I know that stocks give me a fighting chance to keep pace with or beat inflation
while bonds are almost certain to fall short if inflation runs hot. Let me wind this down by addressing one final question. What would I do with new money today? If someone handed me $1 million right now and asked me to invest it, how would I split it between stocks and bonds? My answer would depend on the time horizon and the person's financial situation, but here's what I'd probably recommend. For someone young, under 45, with decades until retirement, I'd put 95% in stocks and 5% in cash or short-term treasuries. The stocks would be primarily a low-cost S&P 500 index fund with maybe some concentrated positions in high-quality individual companies, I understand. The cash would be for emergencies and opportunities. No long-term bonds at all. For someone middle-aged, 45 to 60, I'd suggest 80 to 85% stocks, the rest in cash and short-term bonds. They're getting closer to retirement, so having a bit more stability makes sense, but they still have 15 to 30 years of investing ahead, plenty of time to ride out market volatility. For someone at retirement age, 60 to 70, I'd suggest 60 to 70% stocks and the rest in bonds and cash. The bonds would primarily be short to intermediate term, not 30-year bonds that are super sensitive to interest rate changes. The goal would be having 5 to 10 years of living expenses in stable assets while letting the stock portion continue growing for the later years of retirement. For someone in their 70s or 80s, depending on health and spending needs, maybe 50-50 stocks and bonds. At this stage, principal preservation becomes more important than growth. But I'd still maintain significant stock exposure because life expectancies are long and inflation compounds over time. These are rough guidelines, not rigid rules. The right allocation depends on individual circumstances, risk tolerance, spending needs, other income sources like pensions or Social Security, and psychological factors. But the key point is that even conservative investors should maintain substantial stock exposure because of the inadequate returns available from bonds. The only scenario where I'd recommend a higher bond allocation is if someone has so much wealth that they don't need growth at all. If you have $10 million and only spend $200,000 annually, you can hold bonds and cash and never run out of money. Growth becomes optional, but most people aren't in that situation. Most people need their portfolios to grow over time to support decades of retirement spending and keep pace with inflation. That's the path I'd follow if I were starting over today. That's the path I'm still following with Berkshire's portfolio. And that's the path I'd recommend to anyone with a long-term time horizon. And the temperament to handle volatility, stocks over bonds, today and for the foreseeable future, until valuations or yields change dramatically enough to shift the calculus. But we're a long way from that point right now. The bottom line is this: bonds have their place for stability and income in certain situations. But for building wealth over time, for keeping pace with inflation, for participating in economic growth and business success, stocks are clearly superior. The question isn't whether stocks are better than bonds. The question is how much better, and the answer is significantly better for anyone with patience and a long time horizon. Let me dive deeper into some specific examples that illustrate why stocks are superior to bonds in practical terms. I think looking at concrete cases helps drive home the theoretical arguments I've been making. Theory is fine, but seeing how these principles play out with real companies and real returns is what really matters. Take Coca-Cola, a stock I've owned since 1988. When Berkshire first bought Coke, the stock yielded about 3% in dividends. Treasury bonds at the time yielded around 9%. On the surface, bonds looked much more attractive. You'd get triple the income from bonds with no volatility. Why would anyone choose stocks? But look what happened over the next 3 decades. Coca-Cola raised its dividend every single year. That 3% initial yield grew to represent a much higher percentage of my original cost basis. Today, the dividend we receive on those original shares represents about 50% of our initial investment every single year. That's a 50% annual yield on cost. No bond in the world can match that. Meanwhile, the stock price appreciated from around $10 per share when we bought it to over $60 today. That's a 6 times return on the stock price alone, not counting decades of dividend income. If I'd bought Treasury bonds in 1988, I'd have collected my 9% interest annually and got my principal back at maturity. Total return over 35 years
maybe 4 times my money. With Coke, including reinvested dividends, I've made more than 20 times my money. This is the power of owning a great business versus lending money at a fixed rate. The business grows its earnings, increases its dividends, expands globally, introduces new products. The bond just pays its coupon and matures. There's no comparison over long time horizons. Or consider American Express, another long-term holding. We bought it in the mid-1960s when the company faced a scandal involving its warehousing subsidiary. The stock had crashed and everyone was panicking. I looked at the fundamentals and realized the core credit card and traveler's check businesses were intact. The brand hadn't been damaged. This was a temporary crisis creating a buying opportunity. If I'd been conservative and bought bonds instead, I'd have earned my fixed return and moved on. But by buying American Express stock at depressed prices, I participated in one of the great business success stories of the past 60 years. The company grew its card base, expanded internationally, maintained premium pricing, generated enormous returns on equity. That initial investment has compounded at double-digit rates for 6 decades. No bond comes close to that wealth creation. These aren't cherry-picked examples. This is what happens when you own quality businesses for extended periods. The earnings compound, the dividends grow, the stock prices appreciate, sometimes dramatically, sometimes modestly, but always moving in a positive direction over multi-decade timeframes. Bonds can't compound this way because they're contractually limited to a fixed payment stream. Let me talk about another dimension of the stocks versus bonds debate that doesn't get enough attention: reinvestment risk. When you own a bond and it matures, you have to reinvest the proceeds at whatever interest rates prevail at that time. If rates have fallen, you're forced to accept lower yields going forward. This happened to bond investors throughout the 2010s as rates fell to historic lows. Imagine buying a 10-year treasury in 2007 yielding 5%. You feel great about locking in that return. Then the financial crisis hits, the Fed drops rates to 0, and when your bond matures in 2017, new 10-year treasuries yield 2%. Your income just got cut in half through no fault of your own. You're a victim of falling interest rates and reinvestment risk. With stocks, you don't face this problem in the same way. Yes, valuations fluctuate and future expected returns vary, but good businesses keep growing their earnings regardless of interest rate changes. Coca-Cola's earnings growth doesn't depend on treasury yields. Apple's innovation doesn't slow down because bond rates fell. The cash flows from your equity holdings keep growing independent of what's happening in fixed income markets. This reinvestment risk is particularly pernicious for retirees who depend on bond income. They set up a portfolio generating a certain income stream, then watch helplessly as bonds mature and have to be reinvested at lower and lower rates. Their income declines year after year. Meanwhile, retirees who own dividend growth stocks enjoyed rising income streams as companies increased their payouts. I've seen this play out with friends and acquaintances who retired in the early 2000s with bond-heavy portfolios. They thought they were being conservative and safe. But as rates fell to 0 and stayed there for more than a decade, their incomes collapsed. They couldn't maintain their lifestyles. Some had to go back to work. Others had to cut spending dramatically. It was painful to watch, and it was entirely predictable. The retirees who owned stocks, particularly dividend-paying stocks, did much better. Yes, they endured volatility in 2008. Their portfolio values fell sharply during the financial crisis. But they kept collecting and growing dividends. And when markets recovered, their portfolios reached new highs. The combination of income growth and capital appreciation left them in far better financial shape than the bond investors. This brings up another critical point about stocks versus bonds: the importance of starting valuations. I've been arguing that stocks are superior to bonds at current valuations, but valuations matter enormously for future returns. If you buy stocks when they're cheap, your returns will be excellent. If you buy when they're expensive, returns will be mediocre. The same is true for bonds. Right now, as I look at the markets in late 2025, stocks are reasonably valued by historical standards.
The S&P 500 trading at 20 times earnings is right around its long-term average. It's not cheap, but it's not expensive either. Compare that to the late 90s when stocks traded at 30 times earnings or more. Those valuations were insane, and anyone buying at the peak suffered through a decade of zero returns. Bonds, meanwhile, offer yields that are below their historical averages when you adjust for inflation. Real yields on 10-year treasuries are around 1.5%. That's lower than the long-term average of 2 to 3%. So bonds aren't particularly attractive on a historical basis either. But the gap between stock expected returns and bond yields clearly favors stocks. If I had to make a prediction, and I'm generally reluctant to make predictions, I'd say stocks will return 8 to 10% annually over the next decade, while bonds return 3 to 4%. That 5 to 7 percentage point difference compounds into an enormous wealth gap. After 10 years, $100,000 in stocks becomes $216,000 to $259,000. In bonds, it becomes $134,000 to $148,000. That's a $70,000 to $110,000 difference. Now, could I be wrong? Of course. Maybe we hit a severe recession and stocks go nowhere for a decade. Maybe inflation stays low and bond returns look better in hindsight. Maybe geopolitical events disrupt markets in ways I can't foresee. Investing always involves uncertainty. But based on the information available today, based on valuations and historical patterns and economic fundamentals, stocks are clearly the higher probability bet. Let me address a question that sophisticated investors sometimes raise. What about using bonds tactically? The idea is to shift between stocks and bonds based on relative valuations and market conditions. When stocks are expensive, move to bonds. When stocks crash, move back to stocks. It sounds logical, but it's incredibly difficult to execute successfully. The problem is timing. You need to be right twice, when to sell stocks and when to buy them back. And the signals are never clear in real time. In late 1999, stocks looked expensive, and many smart investors moved to bonds, but stocks kept rising for another 3 months before finally crashing. If you'd sold in late 99, you missed significant gains. If you'd waited until early 2000, you might have captured the peak, but you still had to decide when to buy back in. Then in 2002 and 2003, when was the right time to rotate from bonds back to stocks? The market was still falling. The economy was weak. There was no clear signal. Some people rotated too early and watched their stocks fall further. Others waited too long and missed the recovery. Very few people got both decisions right. I've never been able to time markets successfully, and I've been doing this for 70 years, and I don't think most investors can do it either. It's much better to own stocks through the cycles, accept the volatility, and focus on long-term returns. Trying to be clever and time the market usually leads to missed opportunities and suboptimal returns. That said, I do think there are times when asset allocation shifts make sense based on extreme valuations. If stocks got to 40 times earnings like they did in 2000, I'd absolutely reduce my equity exposure and hold more cash or short-term bonds. Those valuations are indefensible and expected returns are terrible. Similarly, if bond yields went to 10 or 12%, I'd load up on bonds because those are extraordinary risk-free returns. But we're nowhere near those extremes right now. Stocks are moderately valued. Bonds offer moderate yields. In that environment, my strong bias is towards stocks for all the reasons I've articulated. I'm not trying to time a rotation. I'm just making a straightforward asset allocation decision based on expected returns. Let me talk about one more aspect of this debate that's important. The behavioral challenges of owning stocks versus bonds. Bonds are psychologically easier to own. The value doesn't fluctuate much. You know what income you'll receive. There's no drama, no excitement, no terror. It's boring and predictable. For many people, that's exactly what they want from their investments. Stocks are psychologically difficult. The values jump around daily. Some days you feel like a genius as your portfolio surges. Other days you feel sick as it plunges. The financial media constantly bombards you with reasons to worry. Analysts make predictions that rarely come true. It's easy to get caught up in the noise and make emotional decisions. I've always believed that temperament is more important than intelligence in investing. You can have a genius-level IQ, but if you panic during crashes or get greedy during bubbles, you'll fail as an investor. Conversely, someone of average intelligence who can remain calm and rational will do very well over time. This is why I emphasize buying stocks you can hold forever. If you own businesses you truly understand and believe in, businesses with competitive advantages and strong management teams, it's much easier to hold through volatility. You're not worried about short-term price movements because you know the underlying business is sound. You might even view price declines as opportunities to buy more shares at better prices. But if you own stocks you don't understand or that you bought on tips or because they were going up, you'll panic during crashes. You'll sell at the worst possible time because you have no conviction about the business. You'll lock in losses and miss the recovery. This is how most individual investors end up with returns far below market averages, despite the market itself performing well over time. The solution is to own high-quality businesses, you understand, or to own index funds that represent baskets of quality businesses. Don't own speculative stocks. Don't day trade. Don't try to get rich quick. Just own good businesses and let compound interest work over decades. The behavioral challenge becomes much more manageable when your holdings are fundamentally sound. With bonds, the behavioral challenges are different. The temptation is to chase yield by buying lower quality bonds or longer duration bonds when rates are low, corporate bonds instead of treasuries, 30-year bonds instead of 10-year bonds, emerging market bonds instead of U.S. bonds. Each step down the quality or duration spectrum adds risk in pursuit of a slightly higher yield. I've seen many investors make this mistake. They're not satisfied with 4% from treasury bonds, so they buy corporate bonds yielding 6%. Then the economy weakens, credit spreads widen, and those corporate bonds fall 20% in value. Suddenly the extra 2% yield doesn't seem worth it. They're sitting on big losses and wondering what happened. But the lesson is simple. If you're going to own bonds, own high-quality bonds for the right reasons. Don't chase yield. Accept the modest returns as the price of stability and liquidity. And understand that you're making a conscious trade-off. Lower returns in exchange for lower volatility and certainty. If that trade-off doesn't make sense for your situation, own stocks instead. Let me circle back to the current economic environment, because I think it's critical to understanding why stocks are preferable right now. We're in a period of moderately high interest rates by recent standards, but low rates by historical standards. We have inflation that's declined from its peak, but remains above the Federal Reserve's target. We have strong employment, but signs of slowing growth. We have massive government deficits and political dysfunction that makes fiscal reform unlikely. In this environment, what happens to bonds? If inflation stays sticky around 3% and bond yields stay around 4.5%, real returns are minimal. If inflation accelerates due to continued deficit spending or supply shocks, bondholders get hurt as real returns turn negative. If the economy slows and the Fed cuts rates, bond prices rise but reinvestment rates fall. None of these scenarios are particularly attractive for bond investors. What happens to stocks in these scenarios? If inflation stays elevated, good businesses can raise prices and grow nominal earnings. If inflation falls and the economy strengthens, earnings grow in real terms. If the economy slows, the Fed cuts rates, which typically boost stock valuations. Stocks have multiple paths to positive returns, while bonds are locked into their fixed payment streams regardless of circumstances. This flexibility and optionality is valuable. Stocks adapt to changing conditions in ways bonds cannot. Management teams adjust strategies, cut costs, raise prices, enter new markets, develop new products. Bondholders just collect their coupons and hope inflation doesn't eat away their purchasing power. I also think about the innovation and productivity growth happening in the economy right now. Artificial intelligence, renewable energy, biotechnology, advanced manufacturing. These innovations will drive earnings growth for many companies over the next decade. The companies that successfully deploy AI or develop new drugs or build better batteries will see their earnings and stock prices soar. Bondholders participate in none of this value creation
This is fundamentally why I prefer stocks to bonds. Stocks are claims on human ingenuity, innovation, and productivity growth. Bonds are claims on fixed payment streams denominated in currency that loses purchasing power over time. Given a choice between owning a piece of human progress or lending money at fixed rates, I'll choose progress every time. Let me conclude with some practical advice for people trying to make this decision for their own portfolios. First, be honest about your time horizon. If you need money in less than 5 years, bonds or cash make sense. If your time horizon is 10 years or more, stocks should dominate your portfolio. Don't let fear of volatility push you into bonds when your time horizon argues for stocks. Second, understand your own psychology. If you'll panic and sell during the next crash, maybe a bond-heavy portfolio is better for you, even if it means lower returns. Better to earn 5% and stay the course than aim for 10% but sell at a 30% loss because you couldn't handle the volatility. Know yourself and invest accordingly. Third, if you choose stocks, own quality businesses or index funds. Don't speculate on risky companies or try to time the market. Just buy good businesses at reasonable prices and hold them through market cycles. This simple approach beats almost every alternative strategy over long periods. Fourth, if you choose bonds, understand what you're giving up. You're sacrificing long-term returns for short-term stability. Make sure that trade-off makes sense for your situation, and stick with high-quality bonds that offer genuine safety, not junk bonds or exotic securities that offer neither good returns nor true safety. Fifth, consider a hybrid approach if you're truly uncertain. Maybe 80% stocks and 20% bonds, or 70-30. The exact mix matters less than having a plan and sticking to it through market cycles. The worst thing you can do is constantly second-guess yourself and rotate between asset classes based on recent performance. And finally, remember that investing is not about avoiding all losses or maximizing returns every single year. It's about building wealth over decades while managing risk and maintaining the discipline to stay invested. Stocks offer the best path to long-term wealth for most investors. Bonds offer stability and predictability for those who need it. Choose the path that aligns with your goals, time horizon, and temperament, then stick with it. For me, the choice is clear: stocks over bonds, decisively and without hesitation in the current environment and for the foreseeable future. The expected returns are superior, the inflation protection is better, the quality of assets is higher, and the long-term compounding potential is vastly greater. The volatility is the price I pay for superior wealth creation, and it's a price I'm happy to pay